All right, hello everyone. We'll have a few more people chiming in here probably, but we are going to go ahead and start off right now. And once again, if you have a question, please go ahead and type it in at any time, and we will be collecting those. But we will start off with Tim Call, starting off here on the presentation here. Obviously, we've seen the markets come back very strong here, and there's a lot of different reasons for that. And, obviously we've seen a wall of worry always, whether it be trade concerns or geopolitical conflicts or concerns about rate increases from the Fed. I think interestingly enough, a lot of these have changed a lot around and new worries always come up, but I'll let Tim take over now.
So on this slide, we showed many of the issues that you hear about today and that we're look at long term as well. All of these issues tend to be facing in the positive direction, even the ones on the left. The Federal Reserve has paused interest rate increases, and they will stop shrinking their balance sheet in October. The geopolitical conflict and the trade wars and negotiations it can be seen as negative but improving. But one should keep in mind there's always geopolitical conflict in the world. There's just a little bit more media coverage of it than previous decades. And that should continue as there are cameras everywhere now. So we see the negotiations progressing for Japan and China, and we might have resolution of some of these trade agreements later this year. With regards to recession, it seemed like Wall Street was worried about an immediate recession a couple of months ago. I've never seen a recession with full employment before. The economy is very strong, growing at around 5% nominally, and inflation adjusted 2 or 3%. So that is not a recession. And when we look for all the indicators of recession, we don't see one near term. So we're tilted to the positive side when we look at the economy and the stock market. And as you see on the next slide, the stock market has rebounded from the sell-off in the fourth quarter. That was the probably the fastest bear market of our lifetimes, down 20% from October till Christmas Eve for the large cap indices and 28% fall for the small cap indices. We're working our way back up, so now we're just where we were 6 or 7 months ago. This market is hard to time on a day-to-day or month-to-month basis. The 100-year average is around 10% per year, and no year is average. But the economy is growing, and there are no signs of it slowing down greatly right now. So in general, stocks tend to go up over time, and it's normal to hit new highs. We went through a 15-year period where we were not hitting new highs. So a lot of the millennials and younger portfolio managers think it's normal to stay in a range and not hit new highs during their lifetime. But that's not what's normal. It's normal to hit new highs a lot. If the 100-year average is 10% per year, and you go through a period of 15 years where the average return is 0, then the other years have to be above 10% just to make the average 10%. We look at things a little bit more academically than that, but in general, that's something to consider. When we do look at this next slide, you see a lot of big negative events and recessions on this page. We don't have any of those big negative events right now. So there's no Great Depression, stagflation, or wars of any huge magnitude drafting the population. So we think we're back in an uptrend for many good reasons. And then when we look at the long-term return of the stock market, as I said, it's 10% per year, but never a 10% year except 2017. So on this page, you see in gray the annual returns, and in red, you see the biggest pullback during the year. So when we look at last year, there was a 20% pullback. So that's why there's a red dot at 20%. And that was the wonderful fourth quarter from October to Christmas Eve. That is larger than normal. It was certainly much, much faster than normal. So far this year, we've had a slight pullback, nothing meaningful. Normal volatility would imply a little bit larger pullbacks during the year, but a good chance for a double-digit return, and it could be much higher than where we are now. So if we look at volatility, there are ways to manage volatility if that bothers you a great deal. So Mark will be able to talk about that.
Yes, hi. We've on this chart speak to the good attributes of a balanced portfolio. I think we've talked about with most of our clients before, it's important to have short-term needs covered in cash, or things that are going to become cash when you need those expenses covered. So the stock market, in our view, is a long-term or longer-term investing. We don't want to have a situation where we have a fourth quarter where we have to sell and then we miss out on the first quarter, because we never know when those sorts of things are going to happen. It is unusual to have a 20% decline without a recession, and certainly to have one within just a couple months and then have it totally rebound essentially in the next 3.5 months is unusual, but it's not crazy. So that's why as we go out longer and longer, we return positive more and more percent of the time. So a 10-year holding period, we're positive 98% of the time. And if we go out to 15 years, we're positive looking at history all the time. And that's in the S&P 500 since the 1930s. So 1 month, you're only positive 6 out of 10 times. So it's a little better than a coin flip, but if you go out longer and longer, you can get very comfortable that you're going to have positive returns over the long term. We do have multi-year cycles going on. There's always cycles. The interesting thing is how the cycles match up and where we are in some of these cycles right now. The blue ones on this page are a little more interesting, or have changed, or we think have the potential to change in the recent past or near future. So one cycle that's been interesting is growth versus value. Growth stocks have done much, much better than value stocks. That was not the case in the fourth quarter of 2018, but is the case so far this year. But over a 5 or 10 year period, growth has done much better than value. Typically, these cycles can last 4 to 8 years, and we're at pretty extreme differential levels right now. So technology and growth stocks have done very well. Some of the other things have already changed. The international markets have not been helpful to balanced portfolios over the last 5 or 6 years. So being more U.S. centric has helped. That can also change soon. The tax rates have changed, and maybe they'll change again in the next few years. Who knows? But a lot of these things are constantly evolving and changing. The interest rate cycle, I think, is very important. The Federal Reserve seems to have paused, at least for the next, let's call it 6 to 8 months. I think there's a good chance they're going to stay on hold. So that is certainly a change over the last 2 years, and the market has seen that very positively. But how these cycles match up is important. Right now, as Tim mentioned, we're seeing a very good economy, and we're not really concerned about too much right now. The inflation part, which is a big negative for any investment, is the kind of unnamed or underappreciated risk, in my opinion, and I think in Tim's too. But we're just not seeing it right now. It is unusual to go this long without seeing inflation, but it's been very tame. This next chart is about the valuation of the S&P 500, 400, and 600. So you got small, mid, and large caps. Right now, they're all pretty similar. We see at the turn of the millennium, large caps were very, very overvalued versus small and mid caps. That was the tech boom and mega cap boom. Since the financial crisis, small and mid caps have been valued at higher levels. That's what I would call typical because they tend to grow faster. And right now, they're kind of all at similar levels, not too big of a spread. But there has been a sharp rebound in the PE at the beginning of 2019. You can see that 2016 and 17 had a general rise in the PE ratio. And then in 2018, two things happened. One was earnings grew at 25% plus, and the other was the market was flat or down 5% for the year. And particularly in the fourth quarter when the market was down 20%, you see that PE ratio going way down. So we have had a recovery in the PE, but we think the PE ratio right now is somewhat normal versus history. You can see it's kind of in the middle of the range. And also pointing out, you don't have to own the S&P 500. So there could be times when the S&P 500 is very expensive, but there are sectors and opportunities that are not. So a concentrated portfolio can provide buffers to overvaluation, in our opinion. And it happens that all of our styles are below market PEs right now, and that is typical. It would be rare to see many of our styles at above average PEs, but we think we can still find stocks at attractive valuations currently.
There are many ways to value the market and to value stocks. So this just gives an example of one method, the PE. And what this shows when you look at the bottom lines of the page is the valuation of the indexes at the very bottom, and then some of our portfolios above that. And what you can see is even if you think the market's fairly valued or overvalued, you don't have to own the market. You can own a basket of stocks that have a lower valuation, a higher dividend yield, and a higher growth rate. So we think we've achieved this. There are a lot of estimates on this page, but we're very excited about how we're positioned for the current trends in this market. So now we can open up for questions. Brad?
Once again, if you want to type in a question, go down to the questions box, and you can go ahead and type them in. We'll go ahead and take questions that we'd already received in advance here, but please don't hesitate to type in a question. We're always eager to answer all questions. First question, given the run-up in equities, do you view current valuations as excessive? And if so, should investors be moving into more defensive positions in the next quarter and through a higher, maybe possibly a higher cash allocation or higher bond allocation?
So with the market volatility, we're finding lots of what we believe extraordinary opportunities. Even though you see the average market valuation has gone up in recent months, and the average stock has gone up, not all stocks have gone up at the same rate, and some have gone down. So we can find some very interesting names that have what we believe above average growth and very attractive entry valuations. So as we discussed in the presentation, we think market valuation is fair right now, and especially in a growing economy. But we're finding some opportunities that excite us a great deal in the market.
We just got a question in here. Does CMC's 2019 outlook for the market assume trade deals with major countries like China will occur?
We think there's progress being made. A year and a half ago, it was NAFTA that would never be renegotiated, and it was the end of the world. So today, NAFTA's been renegotiated. Now we're on to China. Japan, in the background, is being renegotiated, and progress is being made there. The Europeans getting all these countries together and making an agreement might be last. There's going to be a lot of pain being last. You can negotiate a little harder when there's only one holdout. So a lot of stocks are priced for the trade negotiations not going well and for continued uncertainty. Some of those we believe are oversold, so we are buying those and taking advantage of that. Others that have not discounted that are less attractive to us. So while we have personal beliefs that the trade frictions will lessen as we go through this year and next year, we're keeping our eyes open for all situations, and when it affects individual company, we do expect that company to trade at a discounted rate. So we do factor in contingencies and look at a breadth of situations. So there are lots of things that could occur.
A lot of companies have a huge amount of debt, i.e. BMY, many brought on by acquisitions and mergers. How concerning is this debt?
Yeah, so typically we do not invest in companies that have a lot of debt. This question is specifically about BMY, Bristol Myers, which we have sold since the beginning of the year. But I think if you're in a company that has a ton of debt, you have to look at how it's laddered out. You have to look at whether it's fixed or variable rate. If the assumption is that rates probably won't go much lower from here, you'd want to have more fixed debt. And then you have to look at what the refinance appetite is there out there. So right now, refinancing debt is very easy. There's a lot of appetite for debt. That was not true 5 months ago, so these things can be fickle. So in our portfolio, I'm not particularly concerned about companies that are over-levered because we screen those out. I do believe for the overall market, it is somewhat of a concern. And if you have companies that are dependent on debt to fund their normal operations, then obviously that is not a good recipe for stock price performance. But we think that's one way we can differentiate is being companies that have cleaner balance sheets than the overall market.
One of our disciplines when looking at securities is we only consider companies that have that can produce lots of cash and generate excess cash, and we want to see that improving over time as well. We want to see cash flow generation growing. That gets you out of a lot of these problems with refinancing debt. Many of our companies pay off debt over time, so when it comes due, they have a cash pile where they can do that, and the lenders know that these companies are more stable, and so it's easier for them to refinance debt. However, less than half the companies that trade on the U.S. markets generate cash and excess cash. So we avoid those like the plague. So we do not like companies that are dependent on the financial markets taking new issues of stock and bonds. We want companies that are self-sufficient, and that helps us a lot, especially in recessions.
All right. Another question here. What changed in the market between the fourth quarter of 2018 and the first quarter of 2019? I think we've addressed it a little bit in the deck, but go ahead.
Well, we've highlighted many of the topics. The Federal Reserve has changed its outlook, is not expected to raise rates this year, and will stop shrinking its balance sheet this October. The yield curve is steepened. A lot of people last year were worried about inverted yield curve. It inverted for a week. Right now it's upward sloping, with the 2-year U.S. Treasury yielding 2.25%, the 10-year 2.63. So that difference, which geeks would call, I'm talking about us, we'll say 38 basis points. 38 basis points divided by 225, that's a 10-year rate 17% higher if you look at it that way. But those of us with math majors know you can't take a percentage of a percentage. Recessions and the economy, as we were discussing, just don't take place when you're at full employment. Jobless claims are at a 49-year low. There are more job seekers than job openings. So I think people are more aware of that today than they were certainly in the fourth quarter. The trade negotiations, we believe, are progressing. Washington, D.C. is dysfunctional. We believe it always is dysfunctional, and you never want to really see how a law is made. The markets like dysfunction. They like a split government because fewer laws are passed. You don't get major changes through Congress when there's a split government, and that means if the rules aren't changing, there's more certainty, and companies can make long-term plans. That's very positive. And then in the fourth quarter, there's government shutdown. There were winter storms. This causes short-term economic disruptions. We've been through all of this before. It's more important to look at long-term than month-to-month volatility. So a lot of uncertainties have cleared up, and the major headlines today, other than trade negotiations, aren't affecting the economy much.
We just got a question in here. What kind of value is Boeing going to be when the 737 MAX issues get resolved?
Yeah, that's a tough one. We don't own Boeing generally, so while obviously we follow major news stories that impact the financial markets, we don't follow Boeing specifically. So I can't say I could speak very intelligently about what the value is when the 737 issues do get resolved. From a higher level view, one would assume when and if those get resolved to a positive, where the issue is completely behind them, you would see a pop in the stock, maybe of 5, 6, 7%. Longer term, is that going to make airlines, particularly global airlines, less likely to buy all Boeing products? I think that's very difficult to see right now, considering there's really only two companies. I don't think that will happen, but I do think the stock will pop a little bit, but it could be a long time before these issues get completely resolved. Going back to Transocean BP, those issues took a long time to kind of work their way through the market. So it's a tough question. If Tim has any thoughts.
So there's a shortage of planes right now, and so Boeing's going to be able to sell the rest of its planes rather well. They have a huge backlog. Hopefully they can resolve the software here. We hear there have been 100 successful flights with the new software as they're testing it. So we need regulatory approval in many places, and the consumer usually comes around afterward. So if it's resolved positively, the stock will should rebound and be a little bit stronger. This is their most profitable plane. They have a huge backlog, but they're not delivering now because of this problem. So short term, it's hurting their earnings a great deal. Long term, if resolved and positive, the stock could go up. So the sell-off leaves us with an attractive entry price if you have high certainty of that.
Now, I think we're going to probably end it here. We had said around 20, 25 minutes, so we're almost there. But if there are any other questions, please type them in. Otherwise, I'm going to pass it over to Tim and Mark for, here you go. Over the next 15 years, will there be any impact of global warming and efforts to slow it have on the markets?
Yeah, so this is Mark. On global warming, I think over the next 15 years, there will be impacts. And I think the way the question is worded is interesting. So there's the impact of global warming, and then there's the impact of efforts to slow global warming. So it's very unpredictable on how each of those would impact. We've had very little energy exposure recently, much below the market. Not really due to global warming per se, but we do have in the back of our minds that there may be a shift long term away from what you would consider the old energy sources into potentially new. The difficulty in investing in the new energy sources is that they're massively unprofitable, and we don't typically like unprofitable companies. So it's something I think to keep our eye on. There's other issues, insurance, how that reinsurance, catastrophe insurance, that cycle can be impacted. So there's a lot of different sectors in the market other than just energy that might be impacted. And then there's going to be technological change. Humans throughout our history have had a good record in solving problems through technological change. We have had a very poor record of predicting what those technologies will actually be to solve the problems. So I don't think this is going to be any different, but it's certainly something worth keep your eye on.
We do invest in a few beneficiaries and solution providers with new technology and with environmental concerns. So we like the two of the largest lithium producers. So you need lithium in the rechargeable batteries, whether it's a new car or a cell phone or tablet, and we think that will that will reward us long term. As well with new technologies, we have some companies that directly benefit from the rollout of 5G, and we think we'll see lots and lots of benefits as 5G is rolled out, because it's 20 times faster than 4G. So that's the speed of the airwaves for your cell phone and other devices. So as more items get connected to the internet or cloud, we might see some more productivity efficiencies in the economy, and we plan to benefit from both that and the build out of that infrastructure.
If there are any more questions, please send them in here. Otherwise, we will be posting this call to our website where you'll be able to review it, and we'll have the slide deck there as well. I will pass it over here to Tim and Mark for any closing remarks, though.
Thank you for joining us. Just one thing to keep in mind, the good news doesn't sell newspapers. This is an old term. Bad news does. The media coverage should always be somewhat negative, because that's more exciting. There's no Sunshine Network because it went out of business for low ratings. And so the good news is underreported. The economy is very strong. There's full employment. There's wage growth for the first time in 10 years. We're just beginning to see the benefit of repatriation of foreign profits. So already a few $100 billion with a B of dollars have come back to the United States, are being reinvested, some in new technologies and automation. And then we do have technological advances that we believe will benefit from. So there are a lot of positives. We are planning on taking advantage of those, and we're aware of many of the negatives being reported and many that are not. So one of our jobs is to stay on top of all this. We're working hard at it, and have built a strong track record in doing so.
Well said, Tim. I just want to thank everyone for listening, and reiterate, if you have specific questions or anything about the portfolios of the market, please don't be strangers out there. Take care, everyone.
All right, thank you. That concludes our presentation for the day.